Okay, good morning, everyone, and welcome. We're just going to give people another 2 minutes before we kick things off, but we're very excited to speak to you today about ownership succession. So yeah, we'll just hang on another 1 to 2 minutes, and then we'll get started. Okay, great. Yeah, I can see the slides, Hannah.
Excellent. We have still got a couple of more people that should be joining us this morning, but I think because we've only got the hour, I think we'll make a prompt start.
Okay, sounds good. I should let everyone know as well that the session's being recorded, and that's one of the things that we'll follow up with after the session today is a recording, just so that yeah, you can all have the full piece to refer back to if that's of use. So I'm just going to introduce things, and then I'm going to hand over to my colleague Hannah here, who's going to take you through the meat of the session today. But the plan for the next hour is we'll give you a very quick introduction as to who we are at Baxendale Employee Ownership. Then it's going to be over to Hannah to take you through what some of your succession objectives might be, because this can often be quite personal, and people will come at a really big question, obviously. The ownership succession of your business, people will come at this from different perspectives. So it's quite important to understand, or just to get into a little bit more of the detail of what your objectives actually might look like. Then an overview of what the different succession options actually look like, because it is a very short list in terms of the options that are available to you, and then a closer look at employee ownership. Finally, we'll allow a good amount of time at the end for any questions that you might have, and a look at the next steps as well. So that's the plan for the next hour. Very quick introduction as to who we are at Baxendale. We are specialist advisors on everything to do with employee ownership. So we've been doing this for over 25 years now in terms of helping and supporting clients on their employee ownership journeys. And often that is supporting them with the initial transition, so how they become employee owned, but also supporting existing employee owned businesses with that ongoing journey. And we ourselves know very well that this is never a journey that's sort of done. We have been employee owned. This is our 44th year of employee ownership. As some of you may well know, employee ownership has deep roots in the UK. Most famously, John Lewis has been employee owned since the 1930s. So there are businesses that have been employee owned for a long time. But it's obviously been sort of in the last 10 years or so that this has moved more towards the mainstream in terms of this is one of the ownership succession options which are available to you. Last thing to say is we transitioned, we're coming up on 350 businesses that we have transitioned into employee ownership. So we've seen just about every which way you can put these kind of structures together. So Hannah is very well versed in just about any kind of question you could throw at her. Hannah will have probably seen it before. So that's us. The note I want to leave you on as a handover to Hannah is just this quote from the Federation for Small Businesses that in terms of the data that they have and the surveys they've done, they think that only 35% of UK SME businesses, which I imagine all of you on the call are, only 35% of them have a succession or an exit strategy. So this means that almost 2/3 of businesses in the UK do not feel fully prepared for one of the biggest decisions they'll ever make in terms of their working lives, the sale or the succession of their business. And this is why we feel holding sessions like today are really valuable, just to give you an overview of what the options actually are and how they might fit in with some of the priorities that you have. So on that note, over to you then, Hannah.
Thanks, Simon, for that introduction. I'll just give you a quick introduction to me first before we jump in with our packed agenda for this morning. So I'm Hannah Welsh, and I'm one of the employee ownership consultants here at Baxendale. I've worked in this space for over a decade now, and I spent too many years working for the Employee Ownership Association before I moved over to Baxendale 3.5 years ago. So my role here is to support business owners from across the UK of all different shapes and sizes implement their transitions to employee ownership. And this kind of work has worked really well in Scotland, which is why we wanted to bring the webinar more broadly open to people across the UK. Now, the conversation quite often starts with, well, what are my options when I'm thinking about succession? And what we want to do is we want to really take that back a step, and we want to start to think about, well, actually, what are the objectives for succession? Because until we know what it is that we want to be going away to implement, it's going to be quite difficult for us to look toward defining what might those options look like. So what we believe in the wealth of experience that we've had over 25 years working in this space is that the most successful transitions of ownership occur when business owners have had an opportunity to explore all of the successions options available to them, and then they can pull together a bespoke plan, a plan that meets the individual needs and the succession objectives of their business. So first of all, before we move into a little bit more of the detail, let's look at what some of the succession objectives might be. And in our experience, they fall into these three categories. So we have continuity, we have the commercial objectives, and of course the employees and the wider workforce. Now, I won't go into detail of all of these, but you can have a look at them in your leisure. We will share the slides with you afterwards, but what we start to do when we're early on in a project with a client is we ask them to score the importance of these 20 objectives. And this allows us to be able to score appropriately against a number of succession options and then be able to tailor a bespoke plan that would meet your needs. For example, if a key objective is to sell the business for the highest price, but also you want to make sure that the business can remain in its current location and leaving a legacy for future generations, which are not of any more or less importance, then perhaps we might be thinking about something like a trade sale, etc. But let's jump in and let's start to have a look at what some of the different options will be. So first of all, I guess the one that probably comes to mind first of all is thinking about a trade sale. So a trade sale involves an independent third party buying the business from the current owners. Now, this can involve the purchase of all of the shares to the company, or it could be a sale of apologies, just one second. It can involve either the purchase of all of the shares in the company by a third party or a sale of the company's business and assets. Now, usually this will involve some type of payment upfront from cash that's available in the business, and then the remaining debt to be paid out to you from future profits over a period of time. I'm just going to have a look at the advantages and the disadvantages and then give you some key questions to go away to be able to ask yourselves. So the advantages of a trade sale, in terms of what that might look like, is it can address ownership succession, but not, and also management succession. So if the business doesn't have a management succession plan in place, it's very likely that the third party buyer will bring their own people in to run the business. And another advantage could be that you should be able to realise the highest price if you're able to find the buyer. Now, in terms of the disadvantages, there are probably more of a handful when it comes to a trade sale. So it's quite likely that the buyers will pay more for the business because they can identify savings, they can duplicate skills within your business and their own, which could potentially lead towards things like redundancies or moving and closing down the business's premises. A proportion of the purchase price will certainly be deferred with some lock-ins for the key employees, which is usually thinking about yourselves as being the sellers during this time. The external buyer is not known to the business and will want to carry out some extensive due diligence prior to any sale, and the negotiation around the outcomes of that due diligence and various potential future events that could impact the business can be fairly robust and occasionally adversarial. And finally, the process of finding a buyer, if you do not receive an approach, can be quite uncertain. We tend to find that businesses will use a business broker to help them with their searches when thinking about looking at a trade sale. So here are some of the key questions that you should be thinking about if you are interested in a trade sale. So first of all, have you got a third party buyer that's interested in buying the business? Are the terms of the purchase acceptable to the current owners? Is the business prepared for the necessary due diligence process? And what will the tax consequences of this succession option be? So I think it's really helpful now just for me to touch upon the tax, because I think this will kind of just be a follow through effect. So for many owners, tax will be a key part of your decision. Although the actual amount of tax payable will be dependent on the individual circumstances, there are some common principles that apply to this disposal of shares. So when you sell your shares in a company, you pay capital gains tax, and current capital gains tax rates apply at 18% for basic rate taxpayers and 24% for higher tax rate payers. So it's business asset disposable. Relief can be available on the disposable of qualifying business assets up to a lifetime limit of £1 million of gains, which reduces that rate of capital gains tax to 18%. And to qualify for BADA, several criteria must be satisfied. But broadly, the company must be a trading company or a holding company of a trading group, and the individual must have at least 5% of the ordinary share capital and voting rights. In addition, the shareholder must be an officer or employee of the company, and these conditions must have been met for 2 years prior to the disposal. I'm going to have a look now at a management buyout. So a management buyout involves the management team of a business buying the shares in the company that they manage from the current owners. And usually the management team would set up a new company, NewCo, which would then buy the shares in the business. And there may be some bank borrowing induced to fund the MBO, or the purchase price of the exit can be funded solely through the assets and future profits of the business. The management team then use their combined expertise to be able to grow the business and to drive it forward. So let's have a look at the advantages. So an advantage of a management buyout is it addresses both the ownership and management succession, because the MBO team become the new owners and the leaders of the business. You, as the sellers, know the buyers and you know what they can deliver. So whilst you're taking on that risk, you know that the business will continue to be successful whilst you're stepping away. The management buyout provides continuity for the business. It preserves the values and it ensures that the business can remain in its current location and that employees should be able to keep their jobs. It's highly effective for motivating the management team because they become the owners, they have the skin in the game. And because the management team know what the business can do and what it's capable of, the due diligence should be quite light. And in terms of the disadvantages, so the majority of the price is raised from the current assets and the future profits of the business. So this could mean that as sellers, you may need to wait some time to receive all of the price to be paid for you. In some instances, it can require the management team to raise some of the finances personally. And one of the questions that we come across is the management team in a position to be able to do this? It's quite likely that as a seller that you would expect some personal guarantees from your management team for at least part of the debt. Are they willing to take on that personal risk? They might not be willing to give that guarantee. And then it's thinking about the next round of succession. Will the business be in a place that it's then able to sustain another management team when the current management team are ready to retire from the business? And then we have a couple of key questions here if we're thinking about a management buyout. So does the business have a management team in place? Is the management team willing to buy the shares? Can some of the management team source some funding to be able to pay for the buyout? And what would those tax consequences be for the exiting owners? And similar to the trade sale model, obviously the same rates of capital gains tax will be applicable on the sale proceeds. Again, just to confirm that, looking at the 24% for a higher rate taxpayer, and obviously if you're eligible to qualify for business asset disposal relief, that would be at 18%. One of the other succession options here is family succession, and I'm not sure if we have got any family businesses in the room this morning, so I did just want to touch upon it first of all. So there are a number of ways in which family succession solutions can be structured, but what we're usually thinking here is that the family buyout is where ownership and usually leadership of the business transfers to the next generation of family members, and the senior generation can extract their cash for their shares when they sell the business to that next generation. And in terms of its structure, it can be very similar to the ones of a management buyout again, and the next generation, a family would set up a new co to buy the shares in the business. So we'll just have a quick look at the advantages and disadvantages. So the advantages of family succession is it is usually a non-adversarial process that gives a lot of control to the sellers in terms of the timings and the structure of the transition. It is able to address ownership and potentially management succession. With it being the family, you know who's going to be buying the business, you know what they can deliver. It's making sure that you're providing continuity for the business, looking after its values, making sure that the business can stay in its current location, and it's securing the family's ownership of assets for another generation at least. and the due diligence process should be fairly light. In terms of the disadvantages, very similar to the management buyout, a majority of the price again is usually raised from the current assets and future profits from the business. So again, you probably need to wait some time for you to receive all of the value out of the company. Sometimes there is that question as to whether or not the family will have a discount on the price. Again, similar to management buyout, it may require the family to raise some of the finance themselves. Are they in a position to be able to do this? And one of the other questions that we tend to ask at this point is, by going to the next generation of family, deferring ownership succession for another generation. Very few family-owned businesses make it past third generation of owners. And then we have some key questions here. So first of all, has the family been able to identify family members who are willing to take on the ownership and potentially leadership of the exiting owners? Does the next generation wish to continue family ownership and potentially have non-family board members running the business in instances where the family didn't want to take up those leadership roles? Will the exiting family owners want to keep a retained stake within the business or small minority shareholding? And again, thinking about what those tax consequences would be, similar to the trade sale and to the management buyout. So now I'm going to head into employee ownership, the bit that we're well versed in. So employee ownership. Employee ownership is where all of the employees have a significant and meaningful stake in the business. There isn't one definition out there, but it usually means that at least a majority of the ownership is transferred to the employees via an employee ownership trust. So we call it an EOT. So here we have a diagram where we have the business owners who sell at least a majority of their shares in the company to an employee ownership trust. And this employee ownership trust holds the shares for the benefit of all of the employees in the company. And the company will fund the payment of the purchase price through the surplus assets in the company at completion and the future profits of the business. So if we have a look at the advantages, and there's lots of advantages to employee ownership. So first of all, we're able to address the ownership succession. So we're securing ownership of the business for the longer term. You as the sellers know what the business can do and what it can deliver. You're then able to protect and to provide for the continuity of the business. You can preserve the values, the culture, make sure the business can stay in its current location. The due diligence in an employee ownership transition is very, very light, and it's a very flexible model. It's a very flexible model because we're able to create hybrid structures where some of the ownership can be held collectively for everybody, and a small proportion of the ownership can be made available to key individuals within the business. It definitely is a non-adversarial process. There's a lot of control that you have as sellers in the actual transition in terms of the timing and the actual structure of what that transition looks like. And again, thinking about your own leadership succession around a timetable that works for you to be able to step back from the business. If it is structured correctly, less tax is payable on the sale of your shares to an EOT in comparison to the other options that we talked about this morning. And the bonuses, you can pay income tax-free bonuses up to the value of £3,600 per employee as well. So as long as the EOT acquires at least a majority, so at least 50.1% of the shares, in terms of the tax treatment on the disposal of those shares, you can qualify for a 50% relief on capital gains tax, which in effect is a 12% tax rate on those sale proceeds. So if we have a look at the disadvantages, there's only a couple that we have here. So the purchase price, again, is usually realised via the current assets. So there's usually a completion payment of surplus cash within the business and any other surplus assets that would have been owned by you and not by the company. And then the future profits in the business is then used to pay for the remainder of the purchase price. And that can take some time. And naturally, employee ownership doesn't automatically address your leadership and management succession. So this is something that you do really need to think about. It's not something that needs to be thought about in parallel, but inevitably you will need to have a plan for your own leadership succession. So the key questions when you're thinking about employee ownership, so will some or all of the shares be held in an EOT for the benefit of all of the employees? Will some or all of the employees become individual shareholders within the business? Will the current owners retain a minority shareholding or have any other rights in the new employee-owned structure? So that's thinking about the governance structure. Does the business need a new management team in place as part of the transition? And again, what would those tax consequences be? And in effect, as long as you meet the qualifying conditions, the tax rate is in effect a 12% rate that you would pay. And other options. Now, in terms of the other options, these are probably a bit out there to the left. So just shutting the doors is an option. It's the technical term that's used here is members voluntary liquidation. So essentially what happens is the directors decide to close the business and the shareholders agrees. When all of the debts have been paid, the remaining assets of the company are then paid out to the shareholder and the company is closed. It involves needing for you to have an insolvency practitioner, which would be appointed to carry out the liquidation process. You could also look at private equity or investment. So this is when an external investor buys a stake in a private business in order to increase the value of the business. Now, when you're looking at private equity, their ultimate goal will then be to grow the business and to sell it on in the future to look at their maximum return. So it's thinking about, would private equity align with your objectives? And then we have the initial public offering, so an IPO, which is often referred to as a listing or a floating on the public market. Now, it's probably not as practical here for most SMEs, but I think it's just important here that we do just reference that there are other options here. In terms of the IPO, obviously, before you've done IPO, the only way for you to be able to raise finance is privately. Obviously, going public allows the business to raise large sums of money for its new investors. We don't actually tend to find that we spend a lot of time talking with clients about any of these options. They tend to be, work around trade sales, management buyout, family succession, and employee ownership. So what I'd like to do now is spend more time having a closer look at employee ownership. And we will have an opportunity to do some questions at the end. We've had some that have come in and there is the Q&A function there if you wanted to post some whilst I'm talking this morning. But like Simon said in his introduction, at Baxendale, we're an employee-owned business. And we generally believe that it's a great way to do business. And in the UK, we are approaching almost 3,000 employee-owned businesses. So there is a lot of flexibility about the model and how it works. It works in most sectors of the UK economy and of all businesses of all different shapes and sizes. So I just want to take the next section of this morning just to go into a little bit more detail, just to help you to get a better understanding how employee ownership might work and if it would be a good route for your business. If we link it back to those succession objectives, employee ownership can help businesses achieve a number of things. It can secure the independence of the business. It can ensure that the business has sustainability and continuity beyond the exit of the current owners. It secures ownership succession for the long term, and it gives everyone control over their collective future. And of course, it enables the employees to benefit from the profits that they help to create and to have a meaningful voice in the business that they work in, whilst ensuring that you can have a fair return for your investment. So let's have a look at the structures first of all, because this is what we kind of start with when we're looking at designing employee ownership succession solutions. So the indirect model of ownership, and this is where shares in the company are held collectively for the benefit of all employees, usually via an employee ownership trust. If the shares are owned directly, this means that the employees own the shares personally, and sometimes that can be done using a tax-efficient share scheme. But here we have that flexibility here to have a combination of the two. Now, I would put my hand on my heart and say that in all of the work that I've done in employee ownership, there has always been an EOT as part of it. So everybody is going to benefit from the EOT. And I would probably say a 50% go for a hybrid model of ownership. There are pros and cons to these, and it's about, what are the needs of the business and what's going to deliver those outcomes going forward. So what is an employee ownership trust? It's a discretionary trust for the benefit of current and future employees. It can hold shares and other assets on behalf of employees. In terms of its structure, it is a separate legal entity that's part of your governance structure. And as long as the EOT acquires and holds at least a majority of the shares, the bonuses of up to £3,600 per tax year can be paid free from UK income tax. And for yourselves, in terms of selling shareholders, you can benefit from the 50% reduction in capital gains tax. In terms of direct ownership, it can sit alongside the EOT, but in effect, direct ownership allows employees to share in any increase in value of the business. So if the business is sold or if their shares are sold, hopefully there will be a capital value attached to that. It can allow the employees to be able to share in the profits each year through dividends. It can allow employees to participate in decision making, so they could have voting rights on a limited number of matters. And it can also provide employees with an opportunity to access certain business information. Now, employees usually acquire these shares via a tax efficient share scheme. Usually our clients will explore something like an EMI scheme, an enterprise management incentive scheme. There are other options out there in terms of a share incentive plan, etc. But the enterprise management incentive scheme is probably the most effective one because it can be it's a discretionary share options scheme. So you can grant options to key individuals, whereas using a share incentive plan is an all employee share scheme. But what I would say is that sense of ownership can come from owning shares individually, but actually it can also come from being part of the collective. So the collective, everybody being a part of the EOT, that's what we have here at Baxendale Employee Ownership. And this is why it's really important that you get your communications with your employees right when you start to transition into employee ownership. Once you've designed what that model looks like, helping them to understand how they can participate and how they can benefit can help drive those ownership behaviours that you want to see in an employee-owned business. So the deal structure, you saw this slide previously, but if I just go into it into a little bit more detail for you. So the employee ownership trust is in the bottom left-hand corner, and that is established for the benefit of all of the employees in the company. And the EOT will buy the shares from the selling owners or the shareholders in return for cash from the surplus cash in the company. Like I said, there could be some other surplus assets, but mainly it's cash that comes out to them on completion and a debt that is repaid out of the future profits of the business. Because the company holds all of the cash and assets, the company gives a guarantee to the selling shareholders. And that means that the company will make the payments on behalf of the EOT directly to our sellers. And as you can see, the risk really does sit here with the sellers. So if the cash isn't available, if the business isn't able to generate the profit in the years to come, there won't be any repayments that can come out. So how we design this structure is we make sure it's balanced with some appropriate creditor protections for you. It's also really important here that you think about that management and leadership succession piece as well, because obviously that's going to be a key element to having a successful succession solution put into place. Now, with the deal structure, it's really important that you have the business independently valued before you start a transition through to employee ownership. Within the legislation, there have been recent updates over the last couple of years, but the trustees of the EOT have an obligation to make sure that they take all reasonable steps to ensure that they don't pay more than fair market value for the shares in the company. So our recommendation will be that you have an independent valuation done of the business. And that valuation of the business is usually based upon a multiple of the adjusted pre-tax profit or EBITDA with some adjustments. And then there will be an adjustment for surplus net assets minus any debt within the business. Now, the multiple ranges that we typically see that we're very comfortable with is probably within that 3 to 6 times. My recommendation is that when you have the business valued is that you really understand how the value is applied, the multiple. They usually will look at some comparable transactions and they'll be aware that they've been able to justify how they've arrived at that enterprise value. And if anybody needs any support with some introductions to valuers, we are more than happy to support you with that. Then we move on to the next three fundamental questions. These are the questions that we always ask the client early on in the process is how much is enough? How much can the business afford? And how long would an acceptable repayment period be? Because what we need to remember is that the profits that's going to be used for paying out for the value of your shares is going to come from your post-tax profits. Now, depending on where that multiple sits, if it is a 6 times multiple, we are probably looking at an 8-year repayment, assuming that the profitability of the business stays consistent. If it's a lower multiple, you're probably going to be able to reach financial freedom days sooner. But you also need to think about, is the business going to have to make some investments? If you're going to have to make some external hires in terms of your leadership succession, that will probably eat into the profits, and how might that affect how long it takes to be able to repay the debt down? We do encourage clients that when they're looking at their repayment models that they can build in a slice for the employees to be able to share in the rewards as well and start to realise the benefit of those tax-free bonuses along the way. But we can work with you to design what that repayment model would look like. Now, all of this is balanced with some protections, and I mentioned on the previous slide, that there will be some protections that are put into place. Just to kind of explain a little bit about what some of those might be, quite typically sellers will have some director appointment rights whilst cash is owed to them under the share purchase agreement, so that they've always got a seat around that table. You can expect to receive regular information about the business. So you receive things like P&L, there might be an operational management update that comes along to you, cash flow plans, etc. And that's really good because that keeps you involved with the business. You'll be able to see how the business is performing. You'll be able to identify if there are any sort of headwinds. And then it's thinking about, where other creditor veto rights might sit. So there's usually a big long list of decisions that if you do step away from the company board, that they have to come and get your consent to do things. These decisions can be linked to the constitution of the company and the deed of trust, because we need to ensure that the business remains, the EOT remains a qualifying employee ownership trust, because there is a clawback period that will sit with you. So as I mentioned, you qualify for a 50% reduction in capital gains tax on your sale proceeds, but there is this clawback period, which means that if there is a disqualification event, mainly that the shares are sold to a third party, the business ceases to trade and you head towards insolvency, you're no longer a trading business at that point, which then means that 50% capital gains tax then becomes payable by yourselves. And that clawback period sits with you for the remainder of the tax year in which the transaction happened and the 4 subsequent tax years. So this is why big decisions that could fundamentally affect those qualification requirements, you would need to give your consent to. And also there will be a list of decisions that are primarily financial decisions within the business, which would then prevent the company from going off and spending the profit that should be used for paying down the debt. And then the next step within that is making sure that you can become a secured creditor under the share purchase agreement, which means that in effect you have a charge of the assets of the company at Companies House, just to make sure that you are first in line. So I'll just move on to governance structure. So what will the new governance structure look like in employee ownership? So the company continues to employ the employees and the company continues to be controlled by its board of directors. So it's business as usual. The operational board will continue to be responsible for setting the strategy and overseeing the running of the business. What changed in this new governance structure is that instead of the selling shareholders who will be sitting up on the top left, it's the EOT that now owns at least a majority of the shares in the company and holds them for the benefit of the employees. That said, though, the board's role doesn't change. It's still responsible for running the business, but it will have some extra responsibilities along the way. So it will be obliged to communicate with the employees about the business performance, high level information, and it will also need to engage with the EOT as the company's shareholder. So there will be an expectation that a director will attend a trust meeting. It will present high level information about how the business is performing. It will be an opportunity for the trustee directors to hold the board to account on unlimited things. So there does need to be a relationship between the two. There needs to be transparency, there needs to be trust. The trust needs to feel that it can engage with its directors. The directors need to feel that it can engage appropriately with its shareholder. In terms of the EOT, the default position is that it will have the responsibility of taking big decisions, big shareholder decisions that are in the best interests of the employees, but it is primarily a monitoring role. They're going to be needing to be satisfied that the business is being well run in the best interests of all of its beneficiaries. And I think I've just duplicated that slide a little bit because I started to talk a little bit longer, but here there is another slide that just kind of breaks it down into 2 boxes. Now, as a trustee director, fundamentally, their responsibility is to act in the best interest of all of the employees, and they need to leave the operational board to carry out their own duties. They have fiduciary duties. They're the individuals that hold the personal liabilities of being a statutory director at Companies House. Trustee directors do not get involved in the day-to-day running of the business. And before we move on to having some questions, I've just got an implementation journey here just to kind of set out the scene for what does a transition look like when you move into employee ownership. And I've suggested here that this one takes 6 months. 6 months is a comfortable pace. Sometimes these transitions can be done in 3 to 4 months. Sometimes they take a year. It's all about working at a pace that works for you and for the business. So we break it up into 4 to 5 sections. So first of all, we start with that upfront structuring, where we're looking at what's the deal structure going to look like. We're going to understand what's within the valuation report. We're going to look at what that new governance structure will look like, looking at what your protections will be, so that we can then get to a place where we can apply to HMRC for clearance. The reason why we put the clearance into HMRC isn't to rubber stamp the valuation. I do believe that even after 10 years of working in this space, there is this misconception that HMRC have rubber stamped my valuation. It's all fine. It really isn't. What HMRC are looking for is that you're relinquishing control of the company and that this is a capital disposal. And that's really important to make sure that you have your trust board, that the composition is correct, and that the selling shareholders don't make up 50% or more of the trustee directors. So once we get that clearance back, then it's on with drafting legal documents. So that's drafting a share purchase agreement, new articles of association, and a deed of trust, and making sure that you've had a good opportunity to review those documents with one of our legal partners. Normally at the same point, we're doing some work around employee communications, which quite often involves people like myself and Simon going out into the workplace and talking to employees about, well, what does this transition to employee ownership mean? And we go back right to the basics of, well, what were the options when we were thinking about succession? Because you can paint employee ownership in a really, really positive light. And we start to help the employees understand what this means for them and what their roles and responsibilities will be. And if there's going to be an elected employee trustee director, that's normally when that process will start. And we'll start some sort of campaign internally for them to get those appointments into place. So this is happening in parallel whilst the documents are getting into final form. It'll be no surprise that there's a massive suite of documents at the end that we also need to prepare as part of the sale. We'll then move into phase 4 for trustee training and completion. So this is where we bring trustee directors together and we sit down and we talk to them about what their roles and responsibilities are. And we also help them to satisfy themselves that they're not paying more than fair market value for the shares in the company. That could involve us presenting the valuation, or we ask for the person that did the valuation to come onto the call and to present it and to explain the rationale behind. And then we walk trustee directors through their roles and responsibilities. We explain to them where their power sits and where their power does not sit. We talk to them about their appointments and their terms. We look at how meetings will run in practice. You know, how often will they meet? What will they talk about? And then we have our completion meeting, so that when everybody comes to the completion meeting, there's no surprises around the table. The trustee directors are very happy to sign the documents because they are very comfortable with it. They've had an opportunity to ask their questions, they've had a chance to go away and read the documents, and they are truly satisfied that it is in the best interest of all of the employees to enter into these agreements. And then if we're looking to develop a hybrid model of ownership, we can then look to implement a share scheme, subsequently following on from that piece of work. But like I said, the timetable is very, very flexible in terms of how soon or how long you wish to take. That sweet spot probably is around that 5 to 6 months. I would sit there and say is a nice one. It's not too intense, it's not too onerous, but also it keeps momentum. It keeps momentum going. Simon, I'm just going to stop sharing my screen. I'm going to take a breath.
Sure. Thanks very much, Hannah. And I hope that the attendees found all of that useful. So the plan now is to open up to some questions from yourselves. There is the Q&A function, which you should be able to see in Teams, or you can use chat if you feel that's easier. Likewise, if you'd prefer to ask a question directly, then please do feel free to raise your hand and we can unmute you and welcome to ask your question directly to Hannah. I'm sure that everyone on the call will find these kind of questions that you're asking useful. You know, I imagine most, if not all of you, are in a similar boat in terms of where you are with wanting to explore these options. So I'd encourage you to have a think about what kind of questions you might want to ask Hannah here. While you do that, I have a few questions just to get us started, maybe to get the juices flowing a little bit in terms of some of these thoughts. So the first question I'm going to throw your way, Hannah, is if I were to put myself in the shoes of an SME business owner, one of my concerns might be around what the trust is there to actually do. Particularly if my plan is to continue working the business, continue as a director, potentially running the company. Is the trust actually going to get in the way of me being able to run what has felt like my business up to this point? Can directors still take quick decisions if they want to?
Yeah, sure. I think that that's a really great question. It's one question that I get asked in different ways, in all honesty. And like I just said, when I was talking about the role of the trust, the trustees aren't there to get in the way of the business being run and wanting to influence how decisions are going to be made in the business. That fundamentally sits with whoever is the directors of the business, because that's what they're fundamentally there to do so. And all of this comes down to, well, what does the new governance structure look like? Because there is the default position in terms of decision-making powers that the trust will have that are linked to majority shareholder rights, and that might just be it. But some businesses also like there to be a little bit more of an overlap. And we have the consent, consult, and inform approach. So very early on, we will want to understand, how do you run your business today? Do you already encourage employees or groups of people to participate within the decision making within the business? And then we will design a structure that is bespoke to your business. But ultimately, day-to-day decisions will always sit with the company directors. I don't know if you wanted to add anything to that, Simon, with your experiences as well.
No, I completely agree with you there, Hannah. And yeah, thanks. I think it's very clear. The reality is that every employee-owned business still has to remain commercial. Will still need to be able to make quick decisions. Even the more difficult commercial decisions, the trust should not be slowing those down or blocking them. But obviously, as you say, Hannah, whoever is on the board, whether that's ex-owners or not, are ultimately held accountable by that trust.
Yeah. And I think what's really interesting is when we do our trustee training and we take them through what the governance structure is going to look like and what their roles and responsibilities are. If it's not in the that Simon's described, that I'm the selling shareholder, but I'm staying in my role, if there is a change of leadership, it can be quite helpful to have a session with those individuals to talk to them about what their duties are, what their roles and responsibilities are. How do you lead in a business in employee ownership, and how do you get the most out of your people? And those sessions I think those sessions have real benefit to those new directors or to that senior team, because they fully understand what they're here to do. They know where the line stops. So I think it's looking at what other support can you put into place to kind of mitigate misconceptions and misalignment between those two parties.
Agreed, absolutely. Great. So I have a couple of other questions, but we have a question from Richard in the chat, which I think is a really good one. Yeah, I propose let's jump across to Richard's question, then we can come back to some of mine. So the question is, just for the benefit of everyone else on the call, if the current owners retain some shares, what are the options for selling or passing them on in future? And I'm assuming here, Richard, you're talking about in the context of employee ownership, but obviously correct us if we're wrong. So Hannah, what are your thoughts?
Yeah, sure. I think that's a really great question to ask. And, we see a little bit of retained shareholding in employee ownership. I think it will become more apparent. And I think it comes back to what are those objectives? Because if you've got objectives that you want to retain shares because you want to keep it for a family legacy and you want something to pass down to your next generation, we design a structure that can deliver upon that. If you're wanting to retain shares because you're thinking, well, I've got another 10 to 15 years of left working and I want to have some skin in the game, I want to have an income stream off the back of some dividends, we then can design it as to, well, who's going to buy those shares? The trust would be the natural party to buy those shares, because the trust will always want to own as many shares as it can within the company. There are some technical things around how it all gets structured, but it's really up to you to kind of design what this looks like. Our responsibility is we act and we work with the company directly. So we'll be looking to put a structure in place that works in the best interest of all of the parties. So you probably wouldn't then want to be selling them on to a third party. You'd want them to come back into the company, for them to possibly company share buyback be cancelled. The trust could buy them. You might wish to look at how you could pass them on to the next generation of family or to key employees. There's different ways how it can be designed. is what I would say. There isn't one right or wrong. There are examples that we can talk about when we understand a little bit more about the situation that you might be in and some of the aspirations that you've got. But I see no reason why this can't be designed.
Thanks, Hannah. That's really helpful answer. And we have a question from Duncan in the Q&A as well, which I think touches on a very similar theme. So the question is, can selling shareholders retain some ownership after selling to the EOT and achieving that 50% threshold, as we discussed?
Yeah.
If so, are there any restrictions on future returns for those shareholders?
Not
So,
necessarily.
yeah,
Not necessarily. Sorry, I'm just jumping in on you there. Not necessarily, Duncan. We don't tend to put in minority shareholder discounts into the articles of association. We would look to design what that class of shares would look like in terms of the voting rights. Would make sure there were things that were protected for you in terms of a minority shareholder position. So making sure obviously you could still receive those dividends, changes to articles, which might then mean changing the rights that are attached to your shares, etc. And obviously a sale of the business perhaps. So I think it's thinking about, the percentage of ownership that you might look to retain and what would be an appropriate balance of voting rights that are attached to that. So if you're going to be a 5% shareholder, you're probably not going to have an automatic, appointment right onto the board. If you're going to keep a 25% stake, we probably would look at having those sorts of conversations. But it's all understanding around what's the motives for retaining those shares and what would you like to do with those shares.
Yeah, certainly agreed with Hannah there. And if I might just add a little bit more as my own thoughts, I guess, as Hannah says, I think it's about what are you hoping to achieve with the retained shareholding, and there's lots of pieces around the sort of non-financial side, like Hannah touched on, which could well be very important to you. If it's a purely sort of financial calculation, and you're thinking, well, this business might be worth a whole lot more in the future, and I'd like to retain some shares as almost a hedge against, that value increasing in the future, whilst I take some of the value off the table now in terms of selling to the EOT. The main calculation you need to make is there will be more tax to pay on any subsequent sale, whether it's to the EOT or elsewhere. So you need to be satisfied that the business will grow at least enough to pay the extra tax, which would happen. So you would be, who knows what will happen to capital gains tax, not even in 5 years, in like 5 months. But for the time being, any onward sales of shares, you would qualify for that business asset disposal relief Hannah mentioned earlier. So 18%, which is obviously a higher rate than the 12% you're paying on the sale to the EOT. So, sorry, Hannah, I thought that I'd just add that
No.
in.
No, I completely agree.
But yeah, some really interesting questions there. Please do keep them coming through. In the meantime, I have another question for you, Hannah, on a slightly different note. What are some of the biggest challenges that sellers face during an employee ownership transition?
I think that's also another great question. People always say, what's the challenge here, Hannah? Because actually this sounds too good to be true. You're telling me I can sell my shares to the trust, I can continue to work in the business, I can pay a reduced amount of capital gains tax. What are the challenges? And in my experience, I see leadership succession as being one of the biggest challenges that you can face. Now, for some sellers, they're really fortunate because they're in a fortunate position where they have a senior team that they've built up for a number of years. They know them, they're already getting on with running the business, they're making the decisions, and you feel quite comfortable to step back and let go. And then there are some sellers that have either recognized that they need to find someone and that they need to bring somebody in externally, or they've just not thought, they've always thought, I'm just going to stay here. I'm just going to stay here forever and just continue running this business. And I'll bury my head and I'll deal with it later on down the line. So the recommendation here is, making sure that you've got a plan for what your leadership succession looks like, and making sure that you give enough time and investment to make sure that you're bringing in the right people to be able to run the business. Now, that might involve somebody externally needing to be recruited, and it's thinking about, well, what will the business need in terms of a leader that's got the right cultural fit for a world of employee ownership, in a world where you are, you're wanting employees to participate within the business. So you're wanting them to be engaged, you want them to be involved in the decision making, you want them to feel like they've got a voice and to provide them with opportunity. It's also thinking about, what's that incentive package going to look like? How are they going to empower and engage with employees so that they can understand that if the business does well, they do well. A transparency perspective. And I've seen times where people have brought somebody in externally and they've just not been the right fit for the business, and it's actually been quite detrimental to the progress that they're making with their transition to employee ownership. And that might then mean that you as a seller have to step back in and go back to the day-to-day running of the business. And do you want to be doing that? And how might that affect you with the things that you wanted to go off to do personally, but also what might be the negative impact that that then has on the business and the team? So I think, whilst we don't get involved with the leadership succession piece, we like to understand what the plan looks like. And if there isn't a plan, is this going to be something that you're going to put on the agenda for the next 2 years, or is this 2 to 5 years? And it will probably be something that the trust will be interested in understanding what is the plan. Because if there isn't a plan, they're going to say, we're going to hold you to account on this. We want to understand what are we doing about it. So I think my message here will be leadership succession. There will be other things, but this is the one that kind of jumps out to me now. And Simon, I wonder if you've got anything else that you wanted to add.
No, I would agree with you, Hannah. I think leadership and management succession is the biggest one for sure. I think in more transitions to employee ownership more broadly, there can also be other challenges in terms of, say, mismatched expectations that employees or the senior leadership team might have in terms of what this looks like for them. We like to think that with the advice and support we give clients, that is less of a risk because we ensure that we always manage expectations and everyone should be really clear going into this what this actually looks like, because there isn't a massive change on day one. Often the financial benefit from a sort of an employee's perspective, you have to wait until a little bit later after Financial Freedom Day before you say feel the full financial benefit. But there are obviously many other benefits that can happen from the start, and a lot of this will also be up to you in terms of how you want to design it. So we've had a couple of other questions come in, all really interesting stuff. The next one, Hannah, for you is from Will, and the question is, what is a typical period for paying off owners, and is the tax efficiency hostage to future changes to CGT tax relief during this period? So very interesting one there.
Yeah, absolutely. And so, Will, typical period for paying off owners, I would say is normally in the 5 to 7 years. And that's why those three fundamental questions we answered early on is how long are we happy to wait for the cash and how much can the business afford kind of, arrives at that place. And yes, it is the best judgment that we can make in 2026 if we're sat here today looking at this is a valuation. This is you can't accept more than the valuation, but the price is the price. And we can forecast how long it might take to be paid based upon previous performance. But things can change, can't they? But what I would say is typically that 5 to 7 year period. And I think if I try and interpret the second question that you've got, when the transaction happens, you crystallize on that tax rate at that moment in time. So if a transaction goes through now in this tax year, you will benefit from the 50% reduction, so it becomes 12%, and it will go into your personal tax return and then be paid out in January 2028. So if there are changes in years to come, it won't affect the transaction. Simon's nodding, so I must have answered it correctly.
Just agreeing. Yeah. So if you lock it in, that's it. That's the rate of tax you pay. Even if capital gains tax rate goes all the way up to 40% or whatever in next year's budget, that wouldn't affect you if the sale happened before the budget date. So we are seeing some either current clients or businesses that we've been speaking to who have started to think, well, with the change of leadership, it might be prudent to actually try and complete one of these transitions before any autumn budget statement. But as Hannah outlined in that timeline that we had, it's usually 5 to 6 months is comfortable. It's probably about 4.5 months until the next budget, so it's already looking a little bit tight. but it still would be doable. Okay, so we got the next question, another one from Richard, for you, Hannah. Is there a need
Yes.
for external trustee directors on the trust?
There isn't a mandatory requirement out there for you to have an independent person on the trust, but it will be no surprise that we are huge advocates of having a really balanced trust board composition. So there's only a handful of places where you can get trustee directors from. So of course you can have independents. So these could be people that come from a world where we come from in employee ownership. A couple of us are independent trustee directors for people that we haven't advised. You can have people sometimes ask their accountant or someone that's trusted to the business that you know of, somebody that can really bring that independent perspective to the trust. So you can have independence. I didn't talk about it in the slides, so I'll just give a little bit more detail around who else you can have. So you can have employees. So you can have any employees. You can be democratic in how the employees are chosen. Huge fans of that. Yourself as a selling shareholder, you can't have the automatic right to be a trustee director, but we can give you a position as a trustee director on the trust board. And you can also have board appointed trustee directors. The independence requirement always means that the number of excluded participators, so excluded participators will be in effect the shareholders, the selling shareholders, cannot make up more than 50% of the trustee directors, and neither can the company board be in control of the trust board. So we like to see trust boards of 4 as a minimum. You would have 3. A typical composition could be the seller, who would join as an additional trustee director, an employee trustee director, and an independent. If you go for 4, you might think that you would have an additional trustee director, 2 employees, and an independent. So there's different ways how it can be cut, but I think it needs to come back to, what is the role of the trust? If it is its core role and it's, monitoring the performance, acting as shareholder, making sure that the business is being run in the best interest of all of the employees, it's quite a high level. You probably, 3 to 4 independent if you can afford, because you do have to pay for those independents when they come onto the trust board. It's not a free. So I think it's just working out exactly, the right skill set that you would have on that trust board and making sure that, that it is complementary. And if there is a gap, an independent can fill that gap for you.
Brilliant. Thanks so much, Hannah. I'm conscious we should keep to time and we've only got 3 minutes left. So it might be worth us just very briefly talking about what some of the next steps look like. And obviously, if you wanted to explore any of this with us in any more detail, how you could go about doing that. So I don't know, do you want to share your screen again, Hannah, just for that last slide? Great.
Yeah, I'm just going to share it. Has it come up?
Not for me yet.
So I'm just a second. Let me just close it.
Yeah, got it.
Okay. You have it now?
Yeah, thanks.
Perfect. So in terms of next steps, we will be sending out a copy of the recording of the video shortly and a copy of the slides for you. On our website, we have a successions options portal. So that's a free tool that you can go and use, and you get to score those 20 objectives that were at the beginning of my PowerPoint. And then we can prepare you a complimentary bespoke report that you might want to take away and have a think about, and then perhaps you could come back to us. In the resources hub, there is also a number of articles and documents there that are related to succession and employee ownership in general. If you would like to, we could have an informal, non-obligatory follow-up call with you just to kind of find out how you found the webinar, what attracted you to the webinar, what you're thinking in terms of succession, perhaps answering some more of those questions that we had from the audience around employee ownership. And of course, if you wanted to, you could also go and follow our LinkedIn page where we'll have more insights on succession and employee ownership in general. And here are mine and Simon's contact details if you would like to drop us a line. But we hope that you've really enjoyed this morning's session and that you can leave today knowing that you understood a little bit more about the options that might be on the table and that you have a better understanding about employee ownership. I'm going to stop sharing now.
yeah, so that's it from us. Thank you very much, Hannah. I hope you all found that useful today. And yeah, we'll be in touch with the recording and some of the next steps, as Hannah said. But we wish you a good rest of your Tuesday, and hope to be in touch with some of you again soon.
Thank you, everybody.
Bye then.